In many companies and investment firms, there is a need to put money into different business projects, often requiring cash or equity from their balance sheets. It's important to carefully manage and control how these funds are used to make sure financial goals and expected returns are met. An effective investment management process helps organizations evaluate, appraise, and rank opportunities to ensure they align with the company's vision or investment fund's objectives. This involves having clear approval levels and strong corporate governance, supported by thorough business case processes. The image here shows a simple flow of how investment proposals should be handled, starting with evaluation procedures, moving through a standardized reporting format, and then going through an authorization process that includes pre-funding and funding stages. Finally, the right authorization levels decide if the project is viable or should be rejected, helping keep investments disciplined and aligned with strategic goals. The investment process begins with the evaluation procedure, which sets out how investment decisions are made. Next, the reporting format defines the specific terminology and figures used in the business case, which changes depending on whether the proposal is at the pre-funding stage, before involving external investors, or at the funding stage, when lenders and investors are actively engaged. Following this is the authorization process, where the proposal form is submitted and reviewed at the appropriate level within the organization. The proposal will be judged either unviable or viable, and if deemed viable, it will be approved to move forward to the funding stage with the necessary authorization and funds agreed upon. This first phase includes detailed business case reporting focused on analyzing the scope and outcomes before any external funding is sought. This slide summarizes key financial data including annual cash flows over a 10-year period, covering EBITDA, changes in working capital, project costs, VAT paid or received, and corporation tax, which together calculate cash flow from operations. It presents the base case metrics for Phase 1 pre-funding, showing undiscounted project payback dates and years, along with pre-financing real post-tax IRR and NPV values. Sensitivity analyzers 1 and 2 are also included to reflect how changes in assumptions affect these metrics. The outputs such as NPV and IRR should be calculated and compared using the required post-tax weighted average cost of capital, which is based on assumptions including the real required return on equity, nominal cost of debt, inflation rate, corporate tax rate, and debt-to-equity ratio. This allows us to evaluate the financial viability of the project under consistent and realistic cost of capital conditions. The real cost of debt is calculated by adjusting the nominal cost of debt to account for taxes and inflation. This is done by taking the nominal cost of debt, reducing it by the corporate tax rate and the proportion of debt in the capital structure, and then dividing by 1 plus inflation, subtracting 1 at the end to get the real rate. The real post-tax weighted average cost of capital, or WACC, combines the real cost of equity with this real cost of debt to give a complete measure of financing cost after tax and inflation adjustments. Moving to the business case reporting and funding phase, the analysis covers annual profit and loss accounts over a 10-year period, showing revenues, operating costs, and profits. It includes key financial metrics such as EBITDA, depreciation, amortization, profit before interest and tax, and interest expenses. From there, it moves to profit before tax, corporation tax, profit after tax, dividends, and retained profits. This detailed breakdown helps assess the financial viability and performance of the project over time. This balance sheet provides a snapshot of the company's financial position over a 10-year period, showing how assets, liabilities, and equity evolve. Fixed assets listed here represent the long-term investments in physical items. Current assets include cash at bank, accounts receivable, and reserve accounts, which are funds set aside for specific purposes like debt service and maintenance. On the liabilities side, you see current liabilities such as overdrafts, accounts payable, VAT payable, and corporation tax payable, all short-term obligations due within a year. Net current assets reflect the difference between current assets and current liabilities, indicating liquidity. Moving to long-term liabilities, the senior debt and subordinated debt show the company's longer-term borrowing commitments. Finally, net assets and capital and reserves sections highlight the company's equity position, comprising share capital and retained profits, which reflect accumulated earnings not distributed as dividends. This structure helps in assessing the company's financial stability and its capacity to meet obligations and invest in future growth. This slide presents a detailed breakdown of the annual cash flow over a 10-year period, tracking key financial metrics from EBITDA and working capital movements to project costs and various taxes. Starting with EBITDA, we see how operational profitability fluctuates each year before considering changes in working capital and project costs, which directly impact cash flow from operations. VAT payments and corporation taxes are also accounted for, refining the operational cash flow figure. Interest earned on deposits and interest during construction are included next, providing the cash flow before any funding activities. Following this, equity contributions and debt drawdowns are recorded, distinguishing between senior and subordinated debt. The cash flow available for debt service outlines payments made towards senior debt interest and principal, then moves on to cash flow available before reserve transfers. Transfers to and from debt service reserve accounts and maintenance reserve accounts are factored in, before arriving at the cash flow available for subordinated investors, which covers their interest and principal repayments. Finally, the slide accounts for cash flow before dividends, dividend payments themselves, and the resulting net cash flow, ending with the closing cash balance for each year. This comprehensive view helps us understand how cash moves through the project over time, ensuring all operational, financing, and investment activities are reflected and allowing us to assess overall liquidity and fund availability across the project life cycle. When it comes to authorizing the drawdown of equity or the payment of dividends, approval is required from 3 key levels within the organization due to the significance of these actions for the fund or company's success. These levels include the board, the chief executive officer, and the chief financial officer, each of whom must approve all such transactions. Finance analysts and business proposers, while involved in the process, do not have authorization authority for these decisions. Additionally, any proposal should also comprehensively cover non-financial aspects such as background or introduction, the opportunities it presents, and the associated risks, ensuring a well-rounded business case that supports informed decision-making.